What's up, everybody? In my last video, I talked about how I significantly trimmed my position in Alibaba, and I also slightly trimmed my position in Lyft. So you might be wondering, what did I do with the proceeds? What did I buy? And that's what we're going to talk about in this video today. As always, if you get value out of the video, subscribe to the channel. If you want, consider supporting me on Patreon. And now let's get into it. I haven't fully deployed my capital from these sales yet, but I did add slightly to one of my positions and I did buy into one new stock. First, the position I added slightly to, I'm not going to do a deep dive on this company here because I've talked about it multiple times on this channel, but it is Kaspi, ticker symbol KSPI. This is an absolutely dominant business, a virtual monopoly in Kazakhstan. They are the market leader in payments, marketplace, fintech. They're used by essentially everyone in the country. They have incredible margins. We're talking 50% operating margins while growing. They are currently expanding into Turkey. They have essentially no debt, incredibly high insider ownership. The CEO owns almost a quarter of the company. The chairman owns a little bit more than a fifth of the company. So management and insiders are aligned with us common shareholders. They're running the company with an eye on long-term shareholder value. But currently, the market does not appreciate them at all. They're now trading for less than 7 times forward free cash flow, less than 7 times forward earnings. So I added to my position. I think the risk reward on this company is absolutely incredible. I wish I could find 20 companies in the market that are just as dominant as Kaspi with fundamentals like this company that are trading for a less than 7 times multiple. If I could, I would just invest 5% of my portfolio into each of those 20 companies and go to sleep. But the fact of the matter is, I look at tons and tons of stocks. There are very few companies you can find like this. So while I don't like to be over-concentrated in one name, I rarely invest more than 5% of my portfolio into one company on a cost basis. I have made an exception for Kaspi. This company is currently a little over 6% of my portfolio on a cost basis. I'm okay with that. I think the country risk here is acceptable. Again, nothing here is advice to buy or sell a stock. I'm just giving you my opinion. And in my opinion, the risk reward here is excellent. And I'm telling you what I'm doing with my money. Now let's move on and jump into my new position here. And it is Nomad Foods. This is maybe not surprising if you follow the channel. I've talked about Nomad Foods a couple times in the past. I do like to follow companies for a bit before making a decision to jump in. And even when I do jump in, typically when I enter a position in a company, it's usually for a small part of my portfolio. Nomad is only a 1% holding for me right now. And depending on their future performance, what happens with the price as well, and other opportunities, maybe it will become larger in the future. I'm not sure. If this is your first time hearing about Nomad Foods, it is a wonderfully boring business. They sell frozen food, frozen fish, frozen vegetables, primarily in Europe. It is a very easy and yes, boring business to understand, but they are the market leader in European frozen food. That's not some massive market. It's not like we're talking about cloud computing or e-commerce or something like that. But as you know, regardless, I like investing in market leaders. They're typically more predictable. They might have advantages in scale. This company has grown slowly but steadily over the past decade, and they are consistently profitable. Now, the past couple quarters weren't great. You see that earnings have actually pulled back slightly here. And management cited an unusually hot spring and summer, so that hurts them for a couple reasons. First, when it's hot, demand for frozen fish actually goes down. And second, and more importantly, a hot summer is bad for crop yields. So the cost to produce their vegetables went up, and that reduces margins, and you can see that reflected here. I think most of this headwind is probably temporary. I mean, this company is not going to explode up in earnings, but I think it's basically going to go up in line roughly with inflation, maybe a little bit more. I'm not sure. Nomad thinks that frozen food market is growing faster than the overall food market. They show that here, frozen food growing just slightly faster than total food. Regardless, I think it's likely that demand for their product just ticks up ever so slightly year over year. You can see the breakdown of their revenue here, about a third in seafood, a quarter in vegetables, some in chicken. You have meals here. And in spite of the company just chugging along, just continuing to make money year over year, the stock has sold off massively. In the past year, they are down 30%. Just in the past month here, they're off 15%. Over 5 years, it doesn't look any better. The stock is down 50% over 5 years. Now at $13 a share, I think Nomad has finally gotten to a price where I just think it's too cheap. It is now trading at under 7 times forward free cash flow, under 7 times earnings. And they are using a lot of that free cash flow to return capital to shareholders. They currently pay about a 5% dividends, and they're also aggressively buying back stock. Just 5 years ago, this company had, about 200 million shares. Now it's down to about 150 million. On top of this, the insider ownership is fairly high in this company. The two co-founders here own 8% and 7% of the company respectively. Also, the current CEO owns about 3%, all relatively significant positions. So insiders are aligned with us common shareholders. Now, before we get to forecasting an expected return here for Nomad Foods, I want to talk about a couple things I don't like about the company. A couple red flags. First is the debt. The debt of this company is relatively high. We're talking over $2 billion of long-term debt. And even though free cash flow is about $400 million, debt is still, roughly 5 times free cash flow. It's quite a bit of debt that they have on their books, and they have had this level of debt for a long time. This is just how the company is operated. And while it seems like they've used their debt reasonably to buy up some brands, grow the top line, it's still high. It's higher than I would like. Most of it is coming due in 2028 and 2029. This 800 million euro bond that is coming due in 2028 has a very low interest rate on it, only 2.5%. And this debt is going to have to be refinanced. It's going to have to be rolled over, and it likely will be refinanced at a higher rate. So unless the company focuses on paying down debt, I imagine that interest expense will be going up in a couple of years. On their earnings call, they really don't focus on debt very much. I wish that the management would talk about this more. Now, I understand that overall, the interest rate that they are paying on their debt is fairly low. We're talking about a blended rate of, maybe 6-ish%. That's really a fairly low interest rate on corporate debt. So it makes sense why they're not paying it back, but still, it makes me a little bit uncomfortable. It's definitely something to keep an eye on with the company. So overall, not a clean balance sheet. Also, a lot of their assets are in, goodwill and intangibles. This is from many of the acquisitions that they've made, many of the brands that they have bought. That's not unusual given the business model, but just be aware, there's a net debt position here. Now, the second thing I don't love about the company is just the way that they treat some extraordinary items or unusual items on their income statement. I focus a lot in my analysis on operating income, and operating income is, okay, you have your top line revenue, and then you have all the costs of the goods sold. Okay, once you subtract out cost of goods sold from the revenue, you get gross profit. Well, then you have all your operating expenses, all your overhead. You have to pay your staff. Once you subtract out all these operational costs that your company has, you get down to operating income. Here we are here, operating income, and this is converted to US dollars. So trailing 12 months, we're looking at, about $500 million in operating income. Then below operating income, to get from operating income to net income. Net income is also what we just call earnings. To get from one to the other, you have line items that are not directly related to the operations of the business. So for example, interest. That's a real expense, but it's not directly related to the operations. It's more related to the capital structure that you have. Maybe you sold some assets. You might have even realized a gain on some sales. Well, that's not really part of the core operations of the company. So that's in between operating income and net income. Now, there's this line item here, merger and restructuring charges, and you see that they have a relatively significant expense here every single year. Now, Nomad says in their annual report that the majority of these expenses are related to a multi-year enterprise-wide transformation and optimization program. To me, looking at these expenses, they sound like operating expenses. In fact, in their 20F, they actually include these expenses under exceptional items, and they are above operating profit. So this operating profit number is taking this into account. However, when they report their metrics, when you go and you look at their earnings, like right here, we're looking at their second quarter results, and they're reporting metrics like adjusted EBITDA and adjusted EPS. Part of the adjustment that they make is they back out these expenses. To me, that's a no-no. I don't think that these are unusual items. I think that these expenses are part of the operations of the business. Restructuring charges because maybe you acquired a brand and acquiring and managing brands is core to the operations of your business. That sounds like it should be an operating expense. So I don't like when a company does this with their adjusted numbers. And when I see one thing I don't like, it makes me have to look closer at everything that the company is reporting. This isn't too unusual. I'm not saying that they're doing anything fraudulent here. In fact, many companies do this, but whenever you see an adjusted number, just look closely at what is going on with the adjustment there. Because some companies are adjusting for very reasonable things, but there are some times when you look at that adjustment and really they're just hiding operating expenses in the adjustment. For example, if some tech company is backing out share-based compensation in their adjusted EPS numbers, just know that that's a nonsense number that they are reporting to you. In any case, even after taking all this into account, I think Nomad just looks too cheap. Their operating income is still, 400 to 450-ish million dollars, even if, you back out all these stuff that I think are really operating expenses. Their free cash flow is about 400 million, and this is like a 200-ish billion dollar company. So now let's see what we can expect for a future return if we invest in Nomad stock today. In my base case, I'm just assuming 2% revenue growth. Essentially, they grow in line with inflation, no real organic growth here. Their operating margins have been incredibly consistent over time. I'm just keeping them at 12%. I think that that's fair. Free cash flow margin has been higher, 10 to 11% here. I'm only giving them credit for 8% in our base case. I think they will need to use a little bit of that money to possibly go into some acquisitions to sustain even this modest 2% growth. And then as far as a multiple, I'm only giving them a 10 times multiple, which I think is reasonable for a company like this, market leader, stable margins, but very low growth. And in this scenario, you're looking at a 19% annualized return over 5 years, or more than a double over 5 years. I think our assumptions are pretty conservative here, and I'm looking at an excellent return. As far as my bear case, I assumed no growth at all. They just flatline. Operating margins compress. Maybe they come under a bit of price pressure. I also brought down their free cash flow margin, and I only gave them an 8 times multiple. And even in this scenario, you're up money after 5 years. Yeah, it's only about a 15% total return, but still, you're not down money even with these numbers that we put in here. And as far as my bull case, I don't think I put in anything crazy here. I put in 5% revenue growth, which is roughly in line with where they have been. Now, admittedly, this has been bolstered by acquisitions. So this is optimistic to give them 5% revenue growth and also give them 9% free cash flow margins. But I think it's reasonable in my bull scenario. Operating margin, 12.5%. That's actually totally a normal number. It's not even very high. And I'm only giving them a 14 times multiple, which I think is fair. And in this scenario, you are looking at a 36% annualized return on this stock. That is more than a quadruple, close to a 5x on your money over this time. So overall, when I look at the risk reward here on Nomad Foods, I think it's excellent. Yes, I have some concerns. I'm concerned about the debt. I don't love how they report their numbers, but it's fine as long as you take it into account when you're making estimates for the future. I think I'm getting a great price on this stock right now at $13 a share. When we first looked at it, it was $17.50. I thought it looked okay, but I didn't want to buy in. Again, this isn't advice for you to buy Nomad, just giving you my opinion, telling you what I'm doing. So if you got value out of this video, subscribe to the channel. If you agree or disagree with anything I said, leave that down in the comments below. And I hope to see you all in another video.